Welcome to my comprehensive real estate investing course. This video is designed for the full gamut from beginner real estate investor all the way to the more seasoned investor who's looking to scale their portfolio. I share my 20 years of real estate experience and my process for finding great deals, analyzing them, charging the highest and best rents, financing the deal, and then repeating the process over and over. So let's get started. Guys, you want to invest in real estate, and it's a great idea. It's a great way to generate wealth. The reason I got started in real estate was my neighbor, who was a very wealthy and successful guy, said to me one day, Paul, go find every rich person you know. They all own real estate. Now, since then, I've realized that's not really true, but I get what he was saying. And real estate's a great way to build wealth. It's hard to sell, so you don't sell emotionally as often. It's hard to buy, so you're going to sit there and take more time and make sure you find the right deal. And because of those two things, the returns tend to be better. You have to spend more time and energy working on these deals, so therefore the returns are better. In fact, look at our real estate calculator. Here on the side, it's telling you our average deal has about a 15.93% IRR. And that's with some really crappy ones in there. At 15% return, that's what I'm telling you. Listen, you should try to get those kind of returns, 15 to 20%. If you can't do that, maybe it's not worth it. You're not here to get 9 or 10%. You can get that from a low-cost ETF, dollar cost averaging in the market with a lot less hassle. To go have the hassle of real estate, you need to make outsized returns. 15 to 20% seems very reasonable to me and very attainable. My best deal still makes me over 40% returns on my money. Now, that's a very rare occurrence, but the point is all my deals combined definitely make over 15% and probably closer to 20% returns. And here's the power of that. What I'm trying to teach people to do here is if you do one good deal a year, one great deal a year, be picky, and you're able to make a mere 15% returns, here's what it's going to mean after 30 years. Well, guys, I'm going to be a nerd here and show you guys the numbers. 1.15 to the 30th power minus 1 divided by 0.15. This is the equation for investing money every single year at 15% returns. Now, let's say you're able to invest $25,000 of your own money each year. Now, that's not going to get you a property, but if you couple that with other people's money and some more invested money, here is how well it can do for you. It's a total of $10.868 million in net worth. That's a huge number. And you'd still own the real estate. That's how powerful 15% a year is. Now, what if you're able to get 20% per year? That's going to be harder. But again, doing one deal a year, this 10.868 becomes $29.5 million. Now, a couple of things here. You might sit there and say, Paul, 30 years, I'm 45 years old. So this gives you income during retirement. And you'd be surprised how easy it is to manage 30 houses. It's easier to manage more apartments and more houses than less. Plus, it gives you something to do in retirement. It's not going to be a full-time job having 30 properties. Imagine the cash flow you'll have. Imagine the wealth you would have built. If you, at the age of 75, when you have those 30 properties, sell one per year to live off of and keep going down and down. Sell two per year. You will generate so much cash for yourself, you'll never, ever run out of money. Do you know what all this means? All of this means one thing here. Freedom. And if you're fortunate enough to be under the age of 30 right now, this means freedom before age 60. Imagine that kind of life you can live. And it's there. It's absolutely, absolutely there. The problem is people chase returns. People chase deals. They fall in love with the deal and do it. This whole video is about how you find the one great deal per year. Guys, be picky. Find one great deal per year. Don't just find your first deal and buy it. Find one great deal per year. And this video and my helping you will help you get that. So first off, there are several different types of real estate investing, and it's important for you to understand which one speaks to you the most, because that's the one you will do best in. So first off, there's residential. Now, residential is split up between two different types, single family and multifamily. Single family is basically anything 1 or 2 units at a time. Multifamily is 4+ units. As time goes on and you get bigger and bigger, if you're one of those people who wants to scale, you need to focus here. But just like me, you're going to want to start right here in single family. Single family is a great way to get started with less capital, dip your toe in, and learn how to operate these properties. Here's a little spoiler for you. Multifamily is actually easier than single family. It is much easier to manage 10 plus units in one location than it is to manage one unit in one separate location. And this tends to be the most lucrative. So if you're sitting there going like, damn, I want to get into multifamily, don't worry, you'll get there. But just like me, I had to start at single family to make sure I understood that I liked it and I could handle it. Another form of real estate, commercial. Now, I'll oftentimes hear people say that anything over 4 units in apartments is commercial. I consider commercial office, retail, industrial, and some sort of mixed use. Now, mixed use is usually an area where you either have a mixture of office and retail, or office, retail, and apartments, some sort of combination of them. Now, for me, I have 3 commercial properties, 2 office buildings, and 1 warehouse, which is considered an industrial kind of way. The reason I don't like commercial real estate is I feel like it's feast or famine. When the economy is going great, you're making a lot of money. When the economy is not going great, though, vacancies are up, it's hard to fill those spots, and you have issues. The other thing is I love renovating properties. When you renovate a bathroom or a kitchen in an apartment building, you're going to get higher rents. You're going to get lower expenses. The problem with these is people usually come into a blank slate and they want you to modify, and they're usually trying to save as much money as possible. So really doing those modifications isn't going to drive up your rent a ton. Now, this is the easiest form of real estate. My 3 buildings occupy a total of about 140,000 square feet, and they are so easy to manage. So I do get why people like these. It's a lot easier to manage. The cash flow is more consistent when the cash flow is there. But when you hit a hurdle with the economy slowing down and all of a sudden banks getting tighter, you tend to see a higher vacancy. That's not a good combination to have. Third type of real estate, land and development. Now, guys, there are a lot of developers out there because development is sexy, but development is risky. The reason being is you have to go in there and create something from nothing. So when you're creating it from nothing, you're kind of throwing a little bit of caution to the wind saying, hey, I hope this works. Now, it can work very well, but I have found that developers are the ones who get rich in development on their fees. But when things go poorly, it is very tough. We've only developed 1 property. It was 120 units, and it was a slam dunk home run deal because we partnered with the right land person. We are very cautious about development. I look at development as a way for a developer to collect a lot of fees. And if the deal goes great, awesome. If it doesn't, whatever. They're not worried about it. But when it comes to development, you got to have a lot of knowledge on an area about the rules and zoning, have a lot of access to people in the area, and you spend a lot of money up front trying to get a deal done. When I buy real estate, I like to buy an existing product that I can make better. That fits my personality extremely well. But a lot of developers out there love what they do. They have the money to be able to do it. They have the access to investors to be able to do it. But again, whenever I hear about tough times in real estate, I mostly hear about it with developers, not with the guys like me who go out there and buy properties and make them better. Now, another piece of real estate that I'm very well versed in is vacation rentals and Airbnb. Now, guys, Airbnb has become a very popular thing as of late. And that always draws a little bit of questions for me going, are cities going to start clamping down? They're already clamping down. Now, whenever I look for a vacation rental, I always ask, what's the short-term rental rules in this area? Because a lot of neighborhoods, a lot of high-end places do not want to have short-term people coming in and out all the time, especially gated communities. This was not an issue 10 or 12 years ago because Airbnb did not really exist. There was VRBO, but it wasn't nearly as possible as Airbnb. And I also see on Twitter, Instagram, all these guys talking about ways to make Airbnb millions by subleasing properties. More power to them. I know people who do it very successfully. For our business, we have a vacation rental business that started basically by accident. And we own 3 properties and we sublease another 10 around the world. And it's gone very well for us. But as this grows, there's a lot more competition that's going to drive down prices of rentals. And we have seen some bubble-like behavior that has caused some problems in recent years. But this is a great way if you personally Want to own a vacation rental for your family and rent it on the side? I love this method because it's a great way to basically break even or make a few dollars on an asset that you probably would have lost money on continually as you did not use it. The reason I love this is I personally like owning homes that have great vacation experience on a lake, on the ocean, in the mountains, and it allows me to buy something that I want to own and also figure out a way to make money with it. This all started with one house in Mexico that I bought. And my goal at the time was, listen, if I can vacation here for free and make 4 or 5%, I'm a happy guy. Well, it crushed that. It did so well that we're leased well over 45, 50 weeks a year, literally full rental. We've had to buy 2 other homes, one right next door, one in Turks and Caicos. We're looking at the other side of Mexico because it has worked very well for us. And again, the benefit of this is if it's some lake house that you want to buy for your family personally to use, it's a great way to decrease the cost of holding that asset. Final type of real estate, REITs. What does this stand for? Real Estate Investment Trust. These are basically stocks you buy that own real estate and give you a dividend. Now, the benefit of them is the law states they have to distribute at least 90% of their taxable income every single year. So there's high yields on them. The issue with these is you got to understand what asset they're buying, why they're buying it, and the balance sheet on these real estate investment trusts have to be understood. Same with their profit and loss, because there's a thing called depreciation, which is a non-cash expense. Focus on the cash flow of these. Focus on the assets. And there could be a lot of hidden value in these assets, because when a piece of real estate is owned on a balance sheet, it doesn't increase on the balance sheet as the value goes up. So there could be a lot of hidden value here. Now, because it's so readily available to so many investors and so many people can just go in and buy them, you're not going to make as much money on these as owning and operating your own real estate. And this video and this course is mainly geared towards people who want to own and operate their own real estate. I'm going to walk you through this. I'm going to teach you the things that I did wrong to start. The first major apartment building that I owned, I lost $1 million on. And guess what? The best thing that happened to me. But you've got to learn from that so that when you go do more deals, you do not lose that money. If you have grandiose dreams of owning thousands of apartments, it's going to be very unlikely that you do it on your own with your own money. I'm going to teach you that process as well, how you raise money from people to go build your real estate portfolio. And one of the most important things I teach that not many people say, in fact, I've never heard anybody say this, I want you to have the most expensive rent on the street. I don't want you to buy the most expensive rent. I want you to buy a property and make it the most expensive on the street. Here's a little key that I want everybody to understand. The higher your rent, usually the higher your occupancy, the lower your expenses, and the better the quality tenant you have. Higher rents means more profit and less hassle. That's a very, very important thing that I want you to understand in this course. Before we get any further from that, let's understand some basic financial metrics to understand about a property. First off, net operating income. Now, what this does, it basically takes your revenue minus your vacancy, minus your expenses, and gives you your net operating income. This is before any debt is paid. This is how you're going to evaluate every real estate deal, because the debt in the property should not affect the way in which you look at the overall real estate deal. The debt you put on the property will be after you've decided to buy the property at a certain price. Now, don't get me wrong. Debt is going to greatly affect your internal rate of return and your ROI. And we'll get into that shortly. But for right now, we want to understand if this property was owned in cash, how well would it do? You're going to take your revenue. This is taking all the units, multiplying by the monthly rent, and multiplying by 12. Very simple, okay? Next, you're going to take your vacancy. Guys, you're not going to be 100% full. You might sit there and say, well, Paul, if I have a single family home, it'll be full. Yeah, it will be full, but there'll be times when it's vacant. So over a 5-year period, it might be vacant 5 or 6 months. That is 7 or 8% vacancy over those 5 years. You have to factor that in. And then finally, you take out your expenses. Well, these are important aspects. What are some of the expenses that are involved in property? Well, first off, property taxes. Insurance. And insurance has gone up a ton in recent years. Management fees. Now you might say to me, well, Paul, I'm going to manage it myself. I get that. But any decent bank will tell you we have to underwrite management fees because they're going to want to have to pay somebody if they take the property over. Maintenance and repair. What are you spending to do turnover of units, painting the unit, doing normal maintenance that might happen while the tenant's living there, replacing blinds? These things like that do add up. And what I see most common that I want you to avoid is a lot of property owners will sit there and say, oh, it doesn't matter. I do it all myself. I get that. But if you're trying to build a portfolio, then you're going to have to charge some sort of labor to yourself. Why? Because you're still spending your time doing it. It doesn't have to be a lot. But what would you pay a normal maintenance person to do that work? Just charge it to yourself. Some other expenses. Utilities. Now, you might tell me, well, Paul, if it's occupied, the tenant's going to pay the utilities. In a lot of areas, yes. But if you have an apartment building and you have common area lights, that's utility. You have to sit there and charge that. The other thing is, while the unit's vacant, you have utilities. Yes, it's not going to be a lot, but it's important to understand these. Understand who's responsible for what in that area. And if you're responsible for something, how do you bill the tenant back for that use? We had a property that we paid the water bill for the longest time, and it was so expensive because people didn't care. Then all of a sudden we found a way to submeter the water bills. Guys, once the tenant started paying the water bill, the water usage plummeted. Guys, think about it this way. If you're not charged for electricity, if you have to pay it yourself, how often are you going to turn those lights off? You're going to keep it on all the time. I would. Why not? It's very important you figure out a way to charge every tenant for every utility that goes in that building, but you're still going to have utility costs. Whether it's through an apartment building and common area costs, or whether it's through a single family home while it's vacant and you're doing maintenance to turn it over and get it ready for a new renter. Other things, landscaping. And depending where you live, that could be snow removal, as well as cutting the grass. Now, if you have a single family home, a lot of people will say, well, I make my tenants cut the grass. Make sure you watch them on that because a lot of tenants will not do it. You've got to make sure they're cutting the grass. And if not, figure out a way to find them. There's a city here in a suburb of Cleveland where if the landlord is not cutting the grass, the city comes in and cuts the grass for you and they charge an exorbitant amount of money. What would normally be a $25 or $35 cut, they're charging $145. And I don't blame them. It's a way of getting the landlords to say, hey, I'm going to make sure my tenant cuts the grass or I cut the grass for them. Now, these are not all the expenses, but these are the major ones that you have to factor in when buying any sort of property. There will be other expenses like permits and things like that that are very reliant on the area you're in and the type of property you have bought. Now, once you have your net income, let's do some numbers here because I want to make sure that you understand how it's going to apply to something called a cap rate. Now, cap rate is essentially what's the cash flow return you're going to make on the property if you paid cash. So what's the cash flow? Well, you had your revenue, you had your vacancy, you had your expenses, and you had your net income, net operating income. That net operating income is a certain number. Let's say it's $10,000. So what is your cap rate on the property? It's very simple. It's your net operating income divided by your purchase or investment amount. Let's right now, let's just call it your purchase price. Let's say your purchase price is $150,000. It's $10,000 divided by $150,000, which is 6.66%. This means that if you paid cash for the property, your return would be a 6.66 cap rate. Now, what I'm going to explain to you is always confusing. It confused the heck out of me. So make sure you rewind and watch this over and over. The lower the cap rate, the higher the price of the property. Think about it this way. If it's 10,000 over 200,000, instead of being 10,000 over 150, it'd be a 5% cap rate. So as the cap rate goes down, the purchase price goes up. They work in opposite directions. You want to buy at a high cap rate. You want to sell at a low cap rate, right? Because when the cap rate goes up, the price goes down. So you want to buy at a lower price. That means a higher cap rate. When you're selling, you want somebody to pay you more money for the same income, which means a lower cap rate. Would you rather sell at 5% cap rate, which is $200,000, or a 6.6 cap rate at $150,000? And would you rather buy at $150,000 at 6.6 cap or 5% at $200,000 value? That's the key there. Higher the cap rate, lower the price. Lower the cap rate, higher the price. Now, why does cap rate matter? Well, every area, what drives cap rate? In cap rates, you have earnings, which is net income, divided by price. In PE ratio, you have price divided by earnings. The exact opposite. Also, this is called the earnings yield on stocks. So why would you pay a higher PE for a company? Well, a lot of growth potential. A moat. In the world of real estate, a lot of growth potential would be, can you renovate the property and make a lot more money? Is the location so good that demand keeps increasing, but supply cannot keep up, and therefore rents will go higher and higher? For example, a place like Manhattan. All they can do is build up. They can't build out, and it's hard to build up. So the demand in Manhattan keeps getting higher and higher, yet the supply is not keeping up. That can drive rents higher. But just like in stocks, what I find a lot of times is people will overpay for a great location with the justification that earnings are going to go up a lot faster. It very well could. But remember, people tend to chase what's going on. I want you to avoid that. I want you to look at every real estate deal, like every investment. It's the present value of all your future cash flow. I own properties on the water. I think water property will appreciate at a faster rate than a normal apartment building in Columbus, Ohio. Why? You can't make more water property. But in Columbus, they can keep going out and out and out. Just like in Dallas, just like in Atlanta. They can keep building more out and out and out. But on a water property, you can't just go, okay, I'm going to create more shoreline right here. You can't do that. That's why I believe water properties do sell for a premium and should sell for a premium. For those of you that are in our real estate classes, I want you to remember this cap rate is the reason why we spend a lot of time talking about this, because it is important. I want you to compare your cap rate to your interest rate that you're being charged on the loan. It's a good way of understanding. You want to try to find deals in which your cap rate is higher than your interest rate. Why? Because unless you're going to really drive the value of the property through renovation, it's hard to make a lot of money when your interest rate is higher than your cap rate. If you're making 6%, but you're paying 7%, that's very difficult. Unless there's a way in which that income can go up higher and higher and higher and faster and faster and faster. If you can do that, you can make outsized returns. Now, this all leads to IRR, your internal rate of return. Now, the important thing with IRR is it factors in when you receive the money. Let me give you an example. Let's say you have two investments and they're going to last 3 years. And investment A, these are the cash flows by year, 0, 0, 300. Investment B, 300, 0, and 0. They both made $300. Their return on investment is the same, but their IRR is very different. Why? IRR values more money sooner. So even though their cash flows are exactly the same, this IRR is much higher. Why? Because theoretically, you can take this $300 and do another deal again, do it again and again. So you can make $900 in that time period. While investment A, you have to wait 3 years to get your $300, so you can only do it every 3 years. That's the key for IRR. Now, guys, here's a little spoiler. You can't calculate IRR. It's a complicated guess. Even Excel has to do a very quick guessing until it figures out the right IRR. This is one of my lake properties. This is how it calculates in our software, the IRR. Every year it's calculating a cash flow. Year 0, I have to buy the property, I have to put $400,000 down payment. Year 1, I lost $540,000 due to my renovations, furnishings, etc., to get the property up and running. And then every year I have cash flow going down. And in year 7, I do a refinance. I get a very big cash flow. And it goes all the way down to 20 years. All these cash flows, I sell the property, and I get a check for $1.48 million for a total IRR of 14.59%. Now, if I change some of these assumptions, for example, if I change the market rent to go higher, now it's increasing my cash flow every year. And look at my returns. They went higher, 17.7%. That's the beauty of this real estate calculator. It allows me to put my assumptions in and then change them and see how the values change along the way. The big key here is you need to be able to calculate IRR very quickly. That's why this software is so useful. It's going to do it for you like that. You don't have to sit there and put in Excel, because Excel can do these as well, but you got to manually do it. You got to manually put in each year's cash flow and have it spit it out for you. I use this for one major reason. Look what I'm doing here. I'm going to change the price of the property. Based on me paying $1.925 and putting all this money into it, I'm going to generate 14.59%. If my price goes lower, my IRR should go higher, and it does. 17.35% on 1.73. And if I had paid their original asking price of 2.25, my IRR would be 10.4%. Price drives the IRR so much because the sooner your cash flow is laid out, the lower your returns. So you want to make sure your cash is as little as possible. Another thing is debt. Debt drives this immensely. 80% LTV. If I put at 80% LTV, I'm making 14.59%. If I have a lower LTV, which means I'm putting more down payment, that's more money up front. It should make my returns lower, and it does. Drops it to 13.25. If I'm able to figure out a way to put more debt on, 85%, it goes up to 15.19. This is something we're going to talk about extensively because it's nice to see a higher internal rate of return, and they're driven by so many factors, and debt is the easiest way. That's why developers get in so much trouble. They take on immense debt into a deal that they haven't proven yet with the hopes of it working and making a ton of money. Is the juice worth the squeeze? At the end of the day, you've got to understand your IRR because also the harder the property is to manage, don't you want to make more money? The easier the property to manage, you're okay making less. If you're going to do a lot of renovation, you should make more money. It's more hassle. This is all part of the subjectivity and the art of investing in real estate. You've got to really understand what you're buying and what work you're going to put into it. Because two deals generating 15% each can be very different based on the work involved. 15% and 15%. But here you have to renovate, you have to release, maybe it's a tough area with high vacancy or a lot of bad collections versus this being a Class A property in a great suburb that's brand new. I'd rather make 15% here. That's why this one, maybe you have to make 20 to 25% because it's more hassle. These are the factors that involved in determining your IRR and what's appropriate for that specific deal. Now you'll see here that as time goes on and my cash flow goes up, so does the value of my property. Guys, in real estate, over long periods of time, I will tell you, it's just like stocks. The more the property that makes, the more the value of the property will be. That's very clear. Now, with a single family home like this, there'll be a separate appraisal that's done based on purely what the market dictates because somebody could buy that home for themselves. But if you have a 5-unit building or a 3-unit building or a 20-unit building or a 200-unit building, it's going to be driven purely by how much money the property makes. That'll end up being the value. Now, a lot of people will sit there and say, well, I trust my bank. If they hire an appraiser and the appraiser tells me the property is worth it, I feel comfortable. Not necessarily, guys. Look at 06, 07. Every bank was appraising these properties at absurd amounts of money, but it wasn't justified. What I want to teach you is that you laugh at property appraisals. You sit there and say, okay, fine. Guys, I've paid prices for properties, or banks are saying, Paul, you're overpaying. My number one performing property that I make 40% a year on over the last 10 years, the bank told me I was overpaying. I said, sounds good. And I wasn't. I was not. Why? Because they were focused on what was in place, and I knew I could drive those rents a lot higher. I want you to be so confident that you laugh at the bankers, because guess what? That's what I do. I laugh at appraisals. I laugh at bankers. We do them because we need to get a property value based on it, and we need to get our loan based on it. But I don't ever sit there and look at a bank and think, oh man, they're telling me this. My property's not worth it. Therefore, I should pay less. No. I will use that to my negotiating standpoint with the seller. Like, listen, the property didn't appraise. How do we fix this? Now, the great things about real estate are you can generate cash flow and you can watch your property value appreciate. And as your property value appreciates, when you refinance every so often, because of that bigger value, you're going to get a big check. And that check's going to be tax-free because loan proceeds are not income. I want you to be the kind of investor who focuses on both of these, because a lot of investors only focus on value property appreciation. They're like, hey, I'm fine not making money, but let's look at it this way, guys. Let's say we make our expenses higher here, so our cash flow is zero or negative to start. Now, let's say you buy this lake home and it's awesome. It's a $2 million lake home. The appreciation keeps going up and it's worth a lot of money, and you make your big check in year 7. But along the way, you're losing cash flow. And guys, by the way, it's not a lot of cash flow you're losing. $14,000, $11,000, $9,000, $6,000. If you afford a $2 million home or more, you can afford these. But guys, look at the returns we made. The IRR before was 14.59. Now watch this. 4.81. A huge plummet in return. huge plummet in return. Don't just focus on appreciating a property appreciation. You got to look at the cash flow along the way. That cash flow will allow you to go reinvest at other properties and make more money, or reinvest in the market to diversify. Breaking even or losing just a little bit of money in the first 2 years really drives down that cash flow. Let's make it a little bit better. Let's say that it's basically breaking even day one. You're at 10%, not bad, but it's not 15%. And that difference over a 20-year period of time is millions and millions and millions of dollars. It's not just a small amount of money. So go maximize that. I'm here to teach you that. This is what's so useful about this tool right here. It allows you to really understand these numbers and how the small differences can make a huge difference. Let's do another example. Let's say the broker involved in the deal is sitting there saying, come on, just pay a little bit more for the property. You're fine. It'll be okay. Okay, 1.925, 14.59%. Pay $100,000 more. You might sit there and say, Paul, it only dropped to 13.32. But guys, 1.6% over 30 some years, we've shown it time and time again, is millions of dollars in returns. It's so important that you understand the effect of cash flow on your long-term returns. Now that we understand these very important aspects to understand ahead of time before you start finding your real estate deals, now you got to find these real estate deals. And guys, I can't wait to hear till I'm blue in the face how you got to find a good realtor or a good real estate broker. Spoiler alert, there's no such thing. I'm buying 20, 30, 40, $50 million properties. And every time I hear a real estate broker talk, I just think salesman, salesman, salesman. They don't understand real estate investment. They don't understand the numbers I showed you before. Their job is to purely find you deals. You are not allowed, according to your Uncle Paul right here, to ever take their investment advice. Because once the deal closes, they receive their commission, they will be gone. If you think otherwise, you're the sucker at the table. I'm sorry to say that, but it's absolutely true. My first $1 million loss, it was on me because I'm the one that made the decision to invest. But it was a real estate broker telling me when I was a very young person, you're getting a phenomenal deal here. I said, well, if he's saying that and he's experienced, it must be the case. Guess what? A few months after the deal closed, he got his commission and he moved to North Carolina and became a car salesman. Where was he when I lost my $1 million? Nowhere to be found. And guess what? If it made money, I wouldn't have commended him because I'm the one that managed the property. Once you've bought the property, that price you've paid is done. You can never change that price you've paid. That's why it's so important to focus on finding the right deal. And this is why it's so important to focus on seeing a lot of deals. You need to become immune to finding deals. In fact, everybody who works up with me in our mastermind groups, I always tell them, your first job is to find 10 properties you make offers on. Become immune to being told no, because I don't want you to fall for the same thing that I fell for, which is falling in love with one property and figuring out a way to make that property work. I want you to become so immune to looking at deals that you literally say, cool, move on, move on. We made an offer. They said no, great, move on. Your job is to find the right deal that makes the right money, not to fall in love with the property. These are just numbers to you. Once you own the property, I want you to own and manage that property like it's the most important thing in the world to you. But until then, you need to be so laser focused on finding the right deal that every other deal that comes to you, you need to say no to very quickly. And I will teach you how to do that. The first step is don't fall in love with one property by focusing on one property. I literally want you to look for 100 properties, make offers on 10 of them. And that way, if 3 or 4 get accepted, you focus on the one that's the best deal. If you're able to do that, your returns will increase. Your losses will decrease. That's an absolute fact. It's just supply and demand. If you have 10 options and you have to say, find the best one, you're going to find the best one. If you have 2 options, you have to find the best one, you're limited. It's just logic. And I want you to become good at that. Learn from my mistake. I fell in love with the way a building looked. I said, I want this property because look at how nice it looks. And that cost me dearly. Then I retrained myself into believing, find a property that you can see into a certain look, that you can change it, driving rents higher, making expenses lower, and making a ton of money. So you can go to listings on the MLS with a realtor. And by the way, use the realtor and broker. They're going to help you find deals. But I always tell every realtor and broker I work with, your job is to send me deals, and then that's it. After that, I take over. Also, make sure everybody around you knows what you're doing, because you never know who might know somebody who goes, hey, you know, my aunt has this 4-family that she's had in her family for a long time. She might be willing to sell it. The sooner you can get those deals before they hit market, the better a deal you can get. Now, no matter what deal you're looking at, the best way to find undervalued properties is find properties that are charging low rents or are in bad condition that you can turn that around. Guys, we live in the world of the internet now. You've got Zillow. You've got apartments.com. You've got apartmentguide.com. You have Craigslist. You have all these ways of seeing what people in your area are charging. Go use it to your advantage. And here's another spoiler alert. No one's charging the rent they can. You can always charge a higher rent. People will always pay for better. If you were out looking for a property today, would you sort and look for the cheapest property you could find, a $400 one-bedroom? Of course not. Why? It's probably not in the area you want to be in. You want to find properties with granite countertops, with marble backsplash, with nice light fixtures, with nice flooring, with nice common areas. So find the ones that don't have that and change them into that. And we're going to get into that later. It's called the BRRRR method, and I will break that down for you. But it's a great way to buy, renovate, rent, refinance, and repeat your buying process. But I repeat, your goal should be to have the nicest and most expensive properties on your street. But on your street, what matters is what's going on around you. What can your market support? If you're in an area where the average rent is $4,000 a month, it's a lot different where the average rent is $1,000 a month. And there's a lot of really inexpensive things you can do and upgrade that will make you stand out to the competition that are very, very cost negligible. $50, $60 here or there. But don't be afraid to look at any deal, whether off market or on market. But just remember, when someone's selling you something, they have a vested interest in you buying the property. They will tell you whatever you need to hear to feel good about it. You need to be an independent thinker. That is what I'm trying to teach you in this video and in our mastermind groups. You've got to be an independent thinker. Get advice from people who have no vested interest in you buying that property. The second they get a commission, they will be gone right after. Oh, but Paul, they want to do a lot of deals with me. Okay, I thought the same thing when I was younger. Guess what? At the end of the day, they're going to bring you a deal they know you can close. All brokers care about is, can this person close? Wholesalers are even worse. All they're doing is taking a bunch of lists, marking it up a little bit, and spreading it out to everybody else. Doesn't mean you can't find a good deal, but just remember what their goal is. Their goal is to mass spread to everybody and say, buy this deal. You're going to be focused on the numbers in our real estate calculator. That's going to determine the best deal for you. And there will be shortcuts that I teach you along the way, so you can very quickly say, hey, what's the rent? What's the ask price? Sounds too high. I'm out. I'm going to get you so good at that you'll be able to hear the rent and the ask price and know very quickly if it's even something you're going to waste your time with. I don't want you spending your time analyzing every single deal ad nauseum. I want you to hear rent and ask price and go, oh, sounds interesting. That's how we do it. And we love doing it that way. It saves a lot of time and gets us in front of a lot of deals. And let me ask you a question. If I get in front of 1,000 deals and you get in front of 10 deals, who's more likely to close on one? Of course I am. And that's the key. And also, I'm more likely to get a better deal because I've looked at 1,000 deals. I can pick the best of 1,000. You're going to spend your time looking at 10 deals and you have to pick the best of 10. It's just a numbers game. Now, once you've found your deal, it's time to finance your deal. Now, financing your deal is done one of two ways, or both, a bank or investors. When it comes to investors, it's a great way to scale. Guys, we all can sit there and raise $5,000 or $10,000 on our own. The question is, how do you raise $50,000 or $100,000 to go buy a nice property? Well, best way to do it is find friends and family. Every great real estate investor I've ever heard of started with friends and family. That's how we started. And now we're raising money because we have a track record. You and 5 friends, 6 total people can raise $10,000 or $15,000 each and go have $100,000 to be able to buy a $400,000 property. That is a great start. First, start on your own. Maybe you take 25 grand of your own money, buy a house. Learn the ins and outs of managing. And once you have that track record, it'll be easier to go to a bank and say, hey, I have this track record. Guys, the first property I actually tried to buy was 117 units. The bank rejected me saying, Paul, you can't buy this property because you have no experience. I was like, but I have the money to buy the property. I said, we don't care. We don't have the experience. I lost that property. I was fine with that, but it was frustrating at the time going, okay, I need to figure this out. I had to start smaller. But when you go to a bank, they're going to give you a conventional loan, which is awesome. They're going to require you to put 20 to 30% down. They're going to evaluate the deal, evaluate your credit, and give you a loan. And it's probably going to be fixed for a long period of time. Now, a lot of people like 30-year fixed loans. Me personally, I do not. Why? Because as you saw in my example above, I like to refinance every so often and suck a lot of equity out so I can do it more and more. but your goals may be different. You might sit there and say, Paul, I want to buy one good property a year. And when I wake up 30 years from now, I have X number paid off, X number with very low debt, worth a lot of money. I'm fine with that. More power to you. If that's your methodology, get a 30-year fixed loan. If you want to refinance and do other things, you can do what's called a 10-1 ARM, where you're fixed for 10 years. You can spend the next 10 years raising rents, renovating the property, making it better so the value skyrockets, and you can refinance easily with much more cash flow. Now, there are also private lenders and hard money lenders. Guys, those are gonna be really expensive. But the good news is they're fast, and they'll give you a lot of money to go do deals. But these rates are gonna be very high, 12 to 18% with points up front. Guys, I do not recommend this unless you're doing a quick sort of flip with some sort of property. Other than that, don't bury yourself in debt. Make sure that your property can support reasonable debt levels. If you can't afford that, do me a favor, save more money to put more money down. Don't go to hard money lenders unless it's the path of last resort. Please don't do it. I've seen too many people get buried in it and they sit there and they just try to churn it out. It's too much stress to add to these projects. Now, me personally, I don't need to do private money and hard lending because I have cash sitting around, but it is a good way to get started. And if you have a lot of return, especially in a flip versus a long-term rental, or if you see a lot of value to renovate and increase the value of the property and to go a year later to go to a conventional loan and pay off the private lender, great. But you're going to pay 12, 15, 18% interest. That's a lot. But one of the best ways to finance a property, seller financing. When a seller wants to sell, they're eager to sell that property. You can ask them, hey, take back a note for a little bit. Let's say you buy a property for $200,000. The bank says, we're going to give you 65%. We're going to give you a $130,000 loan. Well, maybe you go to the seller and say, listen, I need you to hold back $40,000. So now you've financed $170,000 of the $200,000. That's 85% loan to value. I recommend this if you have a way of increasing the value of this property very quickly through renovation and increase of rents. If you can make this property worth $250,000 in 1 year because of increasing rents, then all of a sudden you take an 80% mortgage on this, $200,000. You pay off the bank at $130,000, you pay off the seller at $40,000, and you have $30,000 left over, tax-free. You can go do it again with. Seller financing is wonderful because the seller is motivated to get the property sold. And you're going to pay them probably a pretty good interest rate, not private hard money lending rate, but also not the bank rate. If the bank's charging you 6%, private hard money is 15%, maybe you pay the seller 9, 10%, 11%. It allows you to save a few bucks, but allows you to go do the job you need to do, and it's off your credit, which is kind of nice. So here are some terms when you're going to take a loan. LTV, loan to value. In that example before, you bought a property for $200,000, you finance $130,000, that $130,000 divided by $200,000 is 65% LTV, loan to value. Very simple. Now, another important aspect of your loan, amortization. Amortization. What this is how long to pay off the loan. If it's a 30-year amortization, it's going to be paid off to zero in 30 years. If it's a 15-year, it's going to be paid off in 15 years. 20 years, you get the idea. Now, one thing, guys, I like taking the longest amortization I can because I want more cash flow to give me the flexibility to do other things. But the longer the amortization, the higher the interest rate because it's more risk for the bank. They're locking up their money for a longer period of time. This is all why the real estate calculator is so beneficial. Because then you can sit there and put the different interest rates based on the amortization and figure out what the best return and best options for you are. I like the flexibility of having a lower payment. Now, guys, I talked about it a little bit earlier, but I really want to focus on this now. The benefits of debt to real estate. Real estate values don't fly up and down like the stock market. And as long as you have a locked-in rate and you're covering your debt with the appropriate bank requirements, they can't really foreclose on you. So you have a lot of flexibility of thinking about how you raise the value of the property. But having debt does affect your returns. Let me show you. This example here before, the 1.925. At 80% loan to value, we were at 14.59% return over a 20-year period. Now you might sit there and say, well, Paul, I want to put more down. Great. Let's say you put 50% down payment. your return drops to 12.3%. Not bad, but it's significant. Now, the great news is your cash flow will be higher. And a lot of people say, well, why wouldn't I want to do this? My cash flow is $97,500 here versus $67,000, $30,000 difference. Well, you also have to put $876,000 down day one versus $400,000. So if you put 80% down, you could have bought 2 properties instead of the 1 property. And 2 properties generating $67,000 is $134,000 a year in cash flow versus the 1 property at $97,000 in cash flow. It all depends on your risk tolerance. But more debt, higher return. Less debt, lower return. But it's not just about getting the most debt. For example, let's go to 95% LTV. Look at your return here, 16.77. But is that worth it? I don't think so. That's a lot of risk here to have 95% LTV. It's wonderful to have money into deals. In fact, I'm not a believer in no money down or low down payments. I believe in having 25, 30% down payments on as many properties as you can, because that can help manage the ups and downs of the real estate market. And as you increase your cash flow, your loan to value is going lower and lower. Why? Because look right here. As we showed the example here, 2.25 million, I increased my cash flow, it went up a ton. Went up $100,000 in 1 year. That's what's most important, is driving up the value while your loan's going down. But you might have noticed something. My loan's not going down here. Why? I had interest only on this house. And you might sit there and say, Paul, interest only, you're not paying down any debt. That is true. And that is an option for some of these loans. And I take them in situations where I'm going to put a lot of money into the property and greatly increase the value. Remember, I bought this property for 1.925. In year 2, after my renovations, it's worth 2.258 conservatively. I actually think it's worth more than this, but I'm being conservative here. If I actually go to where I think it's worth, I actually think it's worth this. My return goes to 15.5%. But again, I'm looking at this from the standpoint of what feels comfortable for me. I like to be more conservative. I'll make lower assumptions on my value and my cash flow, but I'll be more aggressive on the interest rate, saying, listen, I have no problem not paying down any mortgage. For me, that works. But for a lot of people who want to buy 1 property a year for retirement, pay down your mortgage, especially as rates have been higher lately. When rates were 3%, why would I ever pay that down? But now rates are 6 to 7%. You're getting a guaranteed return on your money of 6 or 7% when you pay down that debt. That's a phenomenal return. That's a guarantee into something that you own. So guys, when it comes to funding a real estate deal, you have debt from a bank and you have equity. You can get debt from a seller, private money lenders. You can raise money from friends and family. There are so many amazing ways to do it, because I'm sure you're not the only person who wants to make more money, and you're not the only person you know who wants to invest in real estate. Get your friends together. Just make sure that if you do that, there are very clear, defined lines on what everybody's role is. So when I say clear, defined lines, it's really, really important that you sit down and tell everybody, here's my plan. Here's how I'm going to manage. Here's how I'm going to do this. And somebody might sit there and say, you know what, I want to get involved too. One person should be in charge of leasing, one person in charge of the maintenance group, things like that. Whenever people start to overlap their roles, it becomes a mess in my experience. Clear, defined lines. Do less, but obsess with your task. That's really, really important to being successful in anything you do in life, but especially when you're doing a deal with friends. Now, if you're managing for this group, also make sure you get paid for that management. Not an exorbitant amount. Make it fair. Make it a reasonable management fee, and make sure it's structured so that as the property does better, your investors get paid very, very well. If the property doesn't do well, don't make it just about you making a lot of money. You're here taking other people's money. You're responsible for that. Make sure they do well before you do well. You don't have the track record yet to be the person who says, listen, I'm going to do this and here are the fees I'm going to charge to make yourself wealthy. When you get that track record, you can then start charging higher fees. But in the meantime, as you build that track record and people putting money behind you, make sure they get paid first. Nothing drives me more nuts than when somebody pitches me a real estate deal and I look at it saying, if this thing does poorly, they're going to make a lot of money still. That is not the right incentives. Make sure your incentives are aligned with your investors. Now, something I've become very well known for in talking about is never, ever, ever hire third-party managers. Now, I know some people are watching this thinking to themselves, oh, come on, Paul, they're not all bad. They are all bad. I absolutely guarantee that if you learn the right way just from this channel, you will vastly outperform a third-party manager. I have hired and fired 10 or 12 third-party managers in my life, and 100% of the time, when I fire them, revenue goes up, expenses go down, profit goes up. 100% of the time, without fail. Now, you might be sitting there saying, well, you hired the wrong property managers. No, these are ones that came highly recommended from a lot of experts in the industry. They're all terrible, and here's why. Their incentives are not aligned with yours. They have no equity in your deal. All they're trying to do is collect their management fees. And on top of that, they're going to charge you management fees, and they're going to mark up labor costs, and they're going to mark up maintenance supplies. They're going to mark everything up. It's a fee generation business. More power to them, but it's not going to be right for you. Keep learning on this channel. You will far, far outperform third-party managers. Now, you might sit there and say, well, Paul, I have a job. I have all these things. I can't manage property. Then do me a favor. Don't buy real estate. I want you to be very successful. I don't want you to just rely on somebody else to just keep things trudging along. Let me explain why their incentives aren't aligned. They want to be able to tell you, look, our occupancy level is higher. Let me tell you one story out of dozens. I had a property and I bought it for $3 million in 2009. I put $750,000 into it, and it just struggled to do very well. It made money, and it was fine. So one day, my partner, Andrew, and I said, let's just sell the property. Let's move on. We asked $5.5 million, and we got one offer of $5.5 million. The problem was the people buying it weren't experienced enough, so they wouldn't get approved. And I remember meeting with them, and we said to them, well, what's your experience here? No, we don't have much experience. So what's your point here? Well, we think your rents are too low. I'm like, we have a third-party manager. These guys are the experts in the area. There's no way you're right on this one. Well, guys, fast forward to about a year and a half later, and we finally realized they were right. At the time that these people had seen the property, our average rent was $478 per month. $478 per month. Now, granted, this is 2010, 11, 12, whatever it was. And our third-party manager was giving 2 months for free to get people in. We fired them. That very same day, we got $600 per month in rent and no 2 months free. Imagine that is more than a 20% increase in rent because we were giving away 2 months at first. That was just the start of it. I remember writing an email, and I was such a dick. I wrote an email 2 years later, and I showed the numbers versus what they did, and I wrote them an email, and I said, guys, you need to get out of the property management business. They never responded to the email, of course. That is just one of many, many, many stories I have about third-party managers. And if you happen to own a property that has a third-party manager, you definitely need to get in touch with me because I will show you how they are sucking. I will absolutely prove how they suck at management. But guess what? When occupancy levels are higher, what about their physical occupancy versus financial occupancy? Now you might sit there and say, what's the difference? Well, let me ask you a question. If the average rent here is $750 and the average rent here is $900, if you're 100% full here, you're collecting $750. If you're 90% full here, you're collecting $810. Would you rather be 90% full and collecting $810 or 100% full and $750? Property managers want this. They want less work. They want to just make sure the rents are coming in, they're collecting their management fee. They want to make sure that rents are so low that they can rent very quickly when a vacancy goes in. What you want is this. Because guess what, guys? Higher rents mean better tenants, lower maintenance costs, and more profit. The incentives are not aligned properly. You might sit there and say, well, Paul, if they're charging a management fee, they're going to get more from here. Yes, you would think so. But they also want to do less work. They're okay making a few less bucks on the management fee. Because remember, they're marking up supplies, they're marking up labor, they're doing all these things. The last thing they care about is this difference. If you said to them, let's get 900, they're going to look at it and go, that's just more work. Why should I do that? I'm going to get paid the same amount of money either way, basically. Because guess what? If their management fee is 4% to 6% on a large property, how much more are they making here? What's 5% of $150? $7.50. Are they really going to try that much harder for $7.50 per unit extra every month? No, they're not going to. And guess what? I don't blame them. I wouldn't want to either. That's why you need to have your incentives aligned together. And you're only going to get that by managing it yourself. I once had a property management company where they agreed to 3% management fees with proper upside. And then I realized a year and a half later, when our upside wasn't increasing, we were never paying them bonuses, that they were marking up my labor costs so much. We had a pipe burst in one of our buildings. And I remember the owner of the management company was there at midnight with his crew. And he took a picture of it. What he didn't realize was that the picture had all the staff just standing around looking at it. And I looked at it going, I'm being charged for 7 or 8 guys to stand there and stare at it. I was like, why are there so many people there? Well, we want to make sure we have it handled. But the pipe burst. Yeah, who'd you call? The plumbing company. They'll handle it then. But at the end of the day, I got charged for 7 or 8 guys on overtime at $20 per hour. You do the math. If you learn on this channel, I can assure you, you will be a much better manager than most property management companies. I would go so far as to say I would take any property management company in the country head to head. And guess what? Another proof is if you ever go to a property management company with a harder property, they'll probably say we're not going to take it. Even if you give them the proper incentives. Why? Because they just want the easier job. More power to them, but that doesn't make you have to be the sucker. So the next question should be, well, Paul, how do I find the best rent for my property? Well, guys, there are plenty of websites. Apartments.com is a great one. I love going there, and Craigslist for smaller properties. Go find the properties within that area. When I say within that area, I mean literally within a street or two at most, because properties and areas can change very big between streets. And then, you know what I want you to do? I want you to add 10 to 20%. Guys, nobody charges what they can actually get. Everybody is under rented. We find this I always tell my staff right now, how are we under rented? Well, we're really pushing it. I don't care about that. There's no way we're charging enough. Go do your research. Go drive by apartment buildings and do me a favor. Houses, go ask to see the unit. Hey, I'm a prospective tenant. Go sit there and see what that unit has. Also, you want to find properties where your competition is terrible at management. You absolutely want to find that because you will absolutely crush it. In fact, if you're trying to buy bigger properties, you should try to buy the properties where the management's terrible, because then you can go in and change things up through your ability to learn from us on how to manage. No area, no property ever charges enough. So go in there, find the competition, see what finishes they have, and then figure out how you can up those finishes and up the price drastically. Another thing, if your property is 100% full, it means one thing. The damn rent ain't high enough. You need to charge higher rent. You want to be in the 90 to 95% range at most. The second you start to get above that consistently, raise your rent. You have to raise the rent. This is basically telling you your rent isn't high enough if everybody's occupied. Now, guys, getting tenants is a fun process. I remember the first time I bought a property and I landed my first unit, I was so excited. Guys, it's not rocket science, but every single month I want you to sit there and say, how do I get the phone to ring more? Craigslist, apartments.com, apartment guide, all these free, Zillow is a phenomenal source. Zillow is a phenomenal source for renting. Now with the internet, there's so many ways in which to get renters. Guys, a sign up front works very, very well. Back when I started in the business, the newspaper was still big. Now, nobody does it. Apartment Guide was all those booklets. Now there's no Apartment Guide booklets, and that's great. Everybody's looking online, but it shows that you have to wow them with your pictures online. And another thing, guys, if you have apartments that range from $985 to $1,250, I want you to do me a favor. Never advertise this price. Always advertise $1,250. Now you might sit there and go, well, Paul, but if I advertise the highest price, I'm going to get less people. You're going to get more qualified people. And as you get more qualified people, when they come in, you say, by the way, our prices are $985 to $1,250. Let me show you them. They came in looking for $1,250. Now you're going to show them a wide range. And they're going to be like, that's awesome. So you're going to get the better quality tenant who's now going to have access to a cheaper property. You're going to be happy and they're going to be happy. Never, ever advertise you're starting at $985. Always advertise the most. Guys, so far in this video, I've said many things that are counterintuitive. Advertise your most expensive price. Don't hire third-party managers. Location doesn't matter. I want you to remember this because these are the things that make things different. I remember when I first started buying property, I'd advertise my lowest price, the number of calls I got that were just a waste of freaking time. Even if it was a qualified person, if they were always calling on the lowest price, they always wanted a deal. I'm not telling you not to give deals. $12.50 a month, advertise that one. Another thing, if you're in lease up mode, only then give 1 month free. And do me a favor, never, ever, ever spread it across the entire lease. So if the average rent is $1,200, don't decrease your rent by $100 a month because it's $1,200 divided by 12. And here's why. If they get used to paying $1,100 a month, they're going to forget their rent was $1,200. So when you want to bump them from $1,200 to $1,225, they're going to say, wait, my rent went from $1,100 to $1,225. And you're going to say, no, it went from $1,200 to $1,225. But they're only going to remember the check they write every single month. Take the hit up front. Take it, free month, get in, get them used to spending the $1,200 a month. That way, when you bump them to $1,225 or $1,250, it's not going to feel like a big jump from $1,100. Another counterintuitive thing. And the funny part was, I learned this because I watched some guy who had 30 years of real estate experience keep splitting up the rents. And I bought a property from him. And so when I went to go increase the rent, so like, wait a second, my rent's jumping $100 a month. I'm like, no, it's not. It's going up $20 a month. No, I'm paying this low price. I'm like, whoa. You got a deal on that one by signing up for 1 month free. And at that point I said, never, ever am I ever allowing any property to do that. And again, we only do this really on lease up because the real thing is never offer 1 month free. Make your properties better. Make it so that people want to live there. Don't give 1 month free unless you're really trying to get rid of some sort of vacancy issue that you have, and be very, very picky about who you give 1 month free to. In fact, we've sometimes offered give the 1 month free at the very end and say, if you make your payments on time for 12 months, you get the 13 month free. We love doing that. Why? It gives them an incentive to be a good tenant. Now, guys, screening tenants is wonderful. Awesome way to do it is get one of those online services that gives you a rental score. But the other thing is, if you own a small property like a home, offer to bring the application to the tenant's current home. That way you see how they live. Are they clean? Are they organized? Take a peek in there. You want to make sure you have a tenant who's going to take care of your property. Now, of course, people say, well, ask for a previous landlord reference. I get that. But at the end of the day, what are they going to give you? They're going to give you their buddy's name if they have to. I'm not telling you everybody is shady, but if you're really that worried about it, don't rent to them. Look at their credit score, look how long they live in the property, how long they've had their job, all these things that you want to make sure you understand. And go see how they live. Go offer to bring them the application to their home so you see if they're organized and clean renters. Don't be afraid to charge a good security deposit. Make sure they know and tell them, listen, the security deposit's high because I want to make sure I get great tenants like you in here. I want to make sure that people have the money to live here. The cheaper it costs them to move in, the more likely they are to bail on you. Now, another big thing, maintenance and repair, M&R. Guys, if you're buying 1 or 2 properties here and you're a handy person, do it yourself. You're going to save a lot of money and it's great. If you have a big property, hire knowledgeable maintenance people and incentivize them on getting more maintenance orders done. We were always very big on that because the longer maintenance orders stay out, the more upset your tenants are going to be. Jump on it. Make sure they have access to a 24-hour number they can call. But don't be afraid to tell them it's not an emergency if they're calling after hours. After hours is only for unlivable situations and emergencies. That's it. If not, kindly thank them for their maintenance orders and tell them you'll get to it the next day. You still have a life too. And yes, it's their place, but if they have a light bulb out, which I would just tell them to do it anyhow, but if they have something as simple like a blind fell, they can still live in their unit with a blind that fell from the window. It's not an unlivable situation that night. Tell them on the next business day, you will handle it. The more boundaries you set up, the more they're going to respect those boundaries. The second you let them do it, cross over that line, guess what they're going to do? They're going to cross over that line over and over and over again. Now, the dreaded eviction process. Guys, I always hear people say, oh, evicting a tenant's such a pain in the butt. They can live there for months and months and months. No, they can't. If a tenant is there long periods of time, 6, 7, 8 months, you either live in a really, really crappy state or you were just lazy. Every time I used to go to Cleveland eviction court, I'd see landlords, they'd be like, oh yeah, my tenant hasn't paid in 8 months. I'm like, where were you in week 1 saying your rent's due? We filed on people immediately because the government already gave them 4 or 6 weeks to get out. So the longer and longer you've waited, the more money you're losing. Get on it. Give them the 3-day notice. They get 5 days in our lease to pay. On the 5th day, they get a 3-day notice. After 3 days, they get filed on, and they got to pay us those filing costs. If they know you're serious, they're going to make sure they pay. There was a property I bought, my second property I ever bought, big property, and I had a manager that had been there for 20 years. I told him before I bought the property, make sure everybody knows I don't mess around. He said that first month that I owned was the highest collection rate they ever had. And then guess what happened? I started to be a little lax. And sure enough, within 3 or 4 months, everybody was paying a little late. Now, late fees are a great source of revenue, but I also have a mortgage that's due in the first of every month. I need to make sure that revenue is in there. So make sure you're strict about it. Although, there's nothing better than a tenant who consistently pays on the 7th or 8th of the month because they never get evicted and they always pay you a late fee. But still, I'd rather have tenants who pay on time. But don't be afraid to file eviction. You have a business to run. You're not UNICEF. You're not a charity. You have a business to run. The courts will definitely take care of them if they have kids, but make sure you file immediately. You have to set the tone early and aggressively. This is what we're doing. Everybody has, I remember the first time I got into real estate, a guy told me, Paul, people are going to take your kindness for weakness. Now you might be watching my other videos saying, how is this guy kind? You know what? That's what happened. I'd believe every story that came in. And before you knew it, you heard every story under the sun. And you started to realize people are just lying. That's fine. Let them lie. Let them lie to somebody else, not to you. And guess what? There are law firms that will go after their money and go take money from every paycheck. Not many, but you'll get something sometimes. It's better than getting zero. Now, one of the most effective ways to really build a lot of wealth is not just to buy a property, a turnkey property. What that means is a property that's ready to go. You buy it, you're renting it already, maybe it's already rented. One of the best ways to make a lot of wealth is to renovate properties. It's called the BRRRR method. Buy, renovate, rent, refinance, repeat, okay? So what you're doing here is you're buying the property. Then you're gonna put money in it by renovating it. What are you renovating? Kitchens and bathrooms mostly, obviously some other things, but we wanna really drive the rents up. Then you rent it out for higher rent. That's really, really important. When you increase that rent, yes, you're increasing your cash flow, but you're also increasing the value of the property. That's the amazing part. Then you're gonna refinance. Why? You have a new value. You've increased the rents of the property. You've increased the value of the property. Now you refinance it, get another mortgage, sucking equity out of it. And then you repeat. You go back and you buy another one, and you keep doing it over and over. I have done this since 2007, 2008, since the financial crisis hit, because I realized back then that in order to really build a lot of value and not wait for the market, I wanted to drive my own property value. The idea was simple. If I bought a property that was making $100,000 a year, and I was able to increase that profit to $200,000 a year, what has likely happened to my property value? It's likely doubled. Because when you buy real estate, you're buying cash flow. If the cash flow is doubled, the real estate value is likely doubled. Now, besides just believing this, let's bring up 2 examples in our real estate calculator to show exactly these numbers. So I'm pulling up our real estate calculator. Now, I've created this property here. It's literally no reno, 123 Main Street. I put in 2 units, 4% appreciation, 10% vacancy. I'm paying $276,000. When I sell it someday, I'm probably gonna pay a 7% commission. I'm doing a 10-year analysis, etc. Now, I'm doing a refinance through year 5. So my income, 2 units, 1,200 square feet, $1,500 rent per unit. Very simple. Expenses, I put some expenses in here, about $7,100 per unit. I'm not gonna get really in the breakdown because I wanted to sort of achieve a property that I could buy and it was worth what I paid for it, and it continually went along with 3.5–4% increase in value and revenue every year. I put my mortgage on here, 75% loan to value, 6.5% interest, 30-year amortization, and I put a refinance after year 5 with 1% in fees and the same terms there. Now, I go to my recap report. Very simple here. My revenue by year, my revenue increase, my expenses, NOI, mortgage payment, blah, 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 okay? The value of the property, I paid $276. After year 1, it's worth $280. Makes sense. Here's the IRR, 16.93%. Okay, not bad. Great deal. If somebody came to me right now and they really believe these numbers and I believe these numbers, I'd say if you could do this over and over again, you're going to make a lot of money. But let's do something a little bit different. Let's see what happens if we renovate the property and increase the rents by a mere $300 per unit. Here is my renovated deal. Everything is the same. Everything is the same. You'll see right here. Generals, everything's the same. Income, everything's the same. Except I put in a market rent of $1,800 per month versus $1,500 when renovating. Expenses, all the same. Here's my rehab. I put in $15,000 per unit. That's quite a bit to put in the unit. Kitchens, bathrooms, some upgrades, etc. That's a good amount of money. And now I'm refinancing again in year 5. Now, let's see the recap report. Everything's here, but look in year 1. My rent increases 24% because I went and renovated it. And look at my property value. Jumped from $280 to $390 after 1 year. $390. And look at my IRR from 16.5% to 24.27%. That's the power of renovation. That's the power of refinancing. Now, let's say I never refinance it. I just put the money, paid cash. Now I'm going to sit in here and I'm going to get rid of will refinance. And I go to the recap report. Everything's the same, the value the same. But now I'm not refinancing it. I'm still getting a 20% IRR versus 16.4 with never refinancing it. Just my cash flow goes up and up and up and keeps increasing every single year until I sell the property. The property value at that point is $533,000. I owe $175. With cash flow, I get back $340,000. That is the power of the BRRRR method. Buy, renovate, rent, refinance, repeat. It can work on any size property. Just this year alone, we bought a 200-unit property in Louisville, Kentucky, and we bought a 40-unit property in Northeast Ohio, and we do exactly that for both. Now, another option you have is when this property value is skyrocketed, sell it, take your gain, go do it again. Now, the benefits to real estate is holding real estate. You have what's called depreciation. It's a non-cash expense. What it says is the government allows you to expense a percentage of the value of the property every single year without laying out any cash. This will decrease your taxable income. And if you have losses still on your property after that, it'll go against your other income that you make elsewhere from your job, from other businesses, etc. And the other thing is, instead of worrying about paying taxes every single time you do this, it allows you just to hold the property and compound for long periods of time. Now, if you choose to do this, the government has what's called a 1031 exchange, which allows you to take the taxable gain on your property and roll it into a new like property, similar property, and not pay taxes on the gain. Guys, not paying taxes on your gains is a great way to compound your wealth. If you're able to do that for a long period of time, you can add several percentage points per year to your after-tax returns. It's very beneficial. But don't be afraid to pay the taxes instead of overpaying for another property. That's why this real estate calculator is so important. It'll actually show you returns based on these factors. You need to consider taxes in your investments, but don't make an investment purely because of the tax benefits. Everybody gets depreciation. When I hear real estate people talk about they love their depreciation because it gives them a write-off of their other income, my goal for you is that you make so much money on your real estate that you still have taxable gains on your real estate. That should be the case. We have that almost every year. Why? Because our real estate does well. You shouldn't brag about having losses. You should brag about having gains even after depreciation. That's the kind of investor I want you to be. The one who brags about your property is doing so well that depreciation doesn't even cover all the gains. Now, real estate development, I've talked about earlier, is another popular idea for a lot of investors. But the thing is, there's so many regulations and so many things to consider. And the other thing is, the people I see do the worst during bad financial times are the developers. I think the margins are not as big as they want. We have built one property with a partner, 120 units, and it was a slam dunk home run. We did great, but we had the right partner who had a great piece of land at a reasonable price. It was also in an underserved market where there was a lot of potential for new properties to come in. It wasn't in a sexy Dallas, Atlanta. It was in a suburb of Cleveland that most people around the country would say, oh, that's not even worth it. It is now a year and a half later, 100% full at rents 20% higher than we originally thought. So for those of you who are looking to get into development, just Crawl before you walk, before you run. First, start by buying a single family home that you can renovate, put money into. Then maybe build something small, 10, 15 units. I will guide you along the way in that path. Now, another thing I want to discuss about real estate is everyone is so obsessed with doing a market analysis. Guys, don't bend over backwards doing this. Make sure you just look at the submarket you're in and focus on the properties around your area. And I want you to specifically focus on how can I be better? If your goal is to be the most expensive and best property on your street, you will do very well because everyone is willing to pay more for better. And someone who's not is not the kind of tenant you want.